my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of New York and London sugar markets. I'll start with ICE raw sugar in New York. The most recent significant move lower was halted 3 weeks ago by a combined support between 1630 and 1681. This support includes within it the 2021 50% Fibonacci line at 1681, as well as the, it's now exiting medium moving average 1688. This halt opened the way for an immediate countering key reversal up and bullish engulfing pattern 3 Thursdays ago. However, as a reactionary move, it lacked depth, and 2 Mondays ago we had another key reversal down. However, as I said 2 weeks ago, and I quote, "I'm not too hopeful for any significant follow-through lower. After all, we are so close to the support band 1630 to 1681 that you may only have a small move lower after all that." End of quote. I was right. The very next day, that is 2 Tuesdays ago, we had a small combined but significant immediate countering bullish Harami and bullish white Mariposa. Since then, we've risen far further than initially I'd anticipated. You see, I had said words 7 weeks ago and repeated since that the market would be, and I quote, going to be between the support 1630, 1681 up to the 50% 21st century absolute Fibonacci level at 1809. End of quote. However, I also added 2 weeks ago, and again I quote, that is until it changes, of course. One day this market is going to make a break one way or another. For the moment, the recent head and shoulders top is dormant, or head and shoulders I should say, I'm trying to say it's a top at the moment. And the middle time, which is currently 1750, of the ever so mildly bullish December 2020 to March 2021 shift pitch walk is just showing a gently direction higher, despite the key reversals down. End of quote. Last Monday, we saw a second attempt higher over the key 21st century 50% absolute Fibonacci line, and a February to date downtrend currently at 1838. I said last week that, and again I quote, the difference this time from the late June stroke early July action is that we're already had a close over the 1809 level last Friday. If prices do so again consecutively, then the 2021 high at 1894 will be in a frame. End of quote. And it was, however, the market this time, as in last week this time, did not have the ammunition to get up there. Last Thursday, prices peeled back down, closing below the 21st century 50% absolute Fibonacci line. Now, on the one hand, we could now see a follow-on lower down through the middle time and all the way back to the support band 1681 to 1630. And that would be fine, because the main bullish incentive, that middle time, is still bullish, and would see the market gather some further ammunition and would have another attempt higher at some future date. However, today is not cooperating in that. We are seeing the market being repelled upwards by some pretty flimsy support, and that is the congestion around 1770 from April, May and June, plus the rising short moving average currently at 1768. The immediate question is, will this be enough to break the 50% absolute Fibonacci line once more and try again up to the key 1894 level? Right now, I'm not too sure, but I'll watch carefully to find out. ICE Europe white sugar. The interesting February to May shallowly bearish shift pitch continues to give the bearish angle of attack here, as opposed to the bullish angle attack in New York. The market is in between the declining middle time, currently 441.20, and the upper time, currently 477.30. Okay, so since the middle of July, when the market reached down and made a new low for 2021 at 412.5, we've seen recovery all the way up through the combination of the following: short medium moving average currently 445.40, the medium moving average currently 447.70, and the current 50% Fibonacci line for 2021, which is not that different from the earlier one at 451.40. Please remember these numbers, as they will surely become important again. Back in late June, early July, the last time prices were up at this congestion, there were no closes over it, despite some serious attempts higher. This failure back then to really break this overhead resistance, especially on a closing basis, caused a subsequent decline. Now, you remember I asked you to keep those two moving averages and that 50% Fibonacci line in mind earlier? Well, 2 Fridays ago the market closed over all of them, properly as well. However, there was no follow through higher with consecutive closes, nothing. Instead, the market started placing contradictory patterns, such that not only did we have an outside week, but it was more bearish than bullish. We closed the week, that's last week, below the recent 50% Fibonacci line, the medium moving average as well, just below the middle time, and almost below the short medium moving average. So going back to what I said earlier, overall, the market still held within the February to May bearish shift pitchfork. At the moment, either side of the middle time, that's where we are. Now, there are some other things you should also look out for. At the current count, we have a possible big double top over 2021, a possible smaller double bottom over March to July, and an even smaller double bottom over June to July. 2 weeks ago I said that I'd be hoping that the market would soon sort out its priorities by maybe giving a clearer signal on which one it fancied. Last week it looked like it might be by prioritizing the June to July smaller double bottom pattern. But then this past week that opportunity was shuttered. And nevertheless we'll leave on for the moment a provisional target X in the 495 even area for that pattern. This is a big ask as it is beyond the upper time and the current high for 2021. However, it all depends if, and it is a big if prices can clear on the upside the double bottom neckline, the lesser Fibonacci level at 460.5, which doesn't look at this moment as if it's going to do it, but it needs to do it by a sufficient margin and have consecutive closes over it as well. That is something that so far we've not seen. Sugar white premium spread. A very clear pattern 3 weeks ago here, a weekly key reversal up based on the middle time, currently 445.50 of the big bearish May 2020 to February 2021 Andrews pitchfork. And this pitchfork has been showing the bearish angle of attack on the market since February. As I said some 5 weeks ago, quote, please note this is declining support as it is appropriate for a bearish pitchfork, so please do not think of it as any form of counter to the overall bearish incentive that is currently evident here. It is, as I pointed out 2 weeks ago, which is now actually 7 weeks ago, until we see the market move out of this strictures, then this bearish pitchfork will prevail, end of quote. So, last week initially started with a gapping move higher, which the market halted just short of the first significant overhead resistance of note, the neckline of the February to November 2020 failed head and shoulders top. That's currently at 75 even. This is not a strong resistance, and I was surprised to see the market halt before it, but it did so, and then turn right back down, so that we closed that week only $1.75 higher than the week before. Last week we'd started in between the two levels, and then headed lower, all the way down to the middle time again, much the way it has done in mid-June to early July as a rolling declining support. After all, it is a bearish pitchfork. Prices bounced up from the middle time at the end of last week. As it seems we are gently and gradually preparing for another trip down along the middle time. Beyond the middle time though, we have support at 41 3/4, 40 1/4 and 26 1/4. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.